We all hear about India being one of the world's fastest growing major economies, right? But what if the very numbers we use to measure all that growth are a bit shaky? Because today, we're going to dig into a surprising report card that's raising some pretty big questions about the data that powers India's economy.
So here's our game plan. We're going to start by unpacking this concerning C grade from a global watchdog. Then, we'll look at the real-world ripple effects of that grade. After that, we'll investigate the two big reasons why this is happening: an outdated yardstick and the tricky shadow economy. And finally, we'll look ahead to 2026, when a major fix is scheduled to happen.
All right, let's jump right in with our first section, a concerning C grade. This whole story really kicks off with a single letter from a very, very important source.
Yep, that's it. One letter, C. The International Monetary Fund, the IMF, they're basically the world's economic referee, has given India's key economic data, what they call its national account statistics, a C grade. Now, this isn't your high school report card, but in the world of global economics, this is a huge red flag.
So what in the world does a C grade actually mean? Well, according to the IMF, it's the second lowest grade you can get. And here's the crucial part: it means the data has issues so serious that they impede the adequate surveillance of the economy. In simple terms, it's like trying to navigate a ship with a faulty compass. It's really hard to get a clear picture of where you're actually going.
The source material puts it pretty bluntly. Getting this grade puts India in a decidedly unenviable position. And trust me, that's not just some technical footnote. It's a serious statement that puts India in some very surprising company, as we're about to see.
And that leads us perfectly into our second section, the ripple effect. Because a grade like this isn't just an abstract letter on a page. It has real, tangible consequences for policymakers and for the economy as a whole. Now, when we say national accounts, what are we even talking about? It sounds complex, but it's really just the main dashboard for the economy. We're talking about all the big indicators: GDP, gross value added, how different sectors are performing, investment levels, how much people are spending, export performance. You get the idea. If these numbers are off, then the decisions being made based on them could be off too.
And hey, remember that unenviable position we just mentioned? Well, this is it. With this C grade, India finds itself in the same category as China when it comes to the perceived quality of its core economic data. That comparison alone really highlights how significant this issue is.
And here is where the rubber really meets the road. Think about the Reserve Bank of India, the RBI. It's their job to steer the economy, mainly by setting interest rates. They make those calls based on their reading of the economy's health. But if the data they're using is built on an old, outdated model, well, that seriously impairs their ability to make the right call at the right time.
So that brings up the big question: why the low grade? A huge part of the answer lies in an outdated yardstick. India is basically trying to measure its fast-moving, modern economy using some surprisingly old tools.
The core of this problem is something called the base year. The easiest way to think about it is like the starting line in a race. It's a single point in time that everything else is measured against. It lets you see how far you've come.
Right now, the base year for India's national accounts is 2011-12. That's over a decade ago. Think about it like this. Would you try to navigate a city today using a map from 2012? Of course not. You'd miss new highways, new neighborhoods, everything. The economy has changed just as dramatically, but the baseline for measuring it is still stuck in the past.
And this isn't just about GDP. The problem is widespread. Other crucial numbers, like the Index of Industrial Production and the Consumer Price Index, that's what measures inflation, are also stuck on that same 2011-12 base year. The IMF actually noted that this old base year is exactly why the CPI only got a B grade instead of an A. It's a systemic issue.
But an old yardstick is only half the story. The other massive challenge is what's often called the shadow economy, and the difficulty of measuring a huge part of the economy that, by its very nature, operates out of sight.
The source text really nails it here. India's informal sector is gigantic. It's made up of businesses and workers that are unregistered and often operate entirely in cash. And as you can imagine, that makes them incredibly difficult to track and measure accurately. This chart gives you a pretty good visual of the problem. We've got the formal, register part of the economy. That's the slice we can measure pretty well. But then there's this other huge piece of the pie, the informal sector, that represents a massive blind spot in the official statistics. So, why does that blind spot matter so much? Because if we could get a better handle on the informal sector, it wouldn't just be a tiny statistical correction.
It could fundamentally change our understanding of India's real growth rate, the true size of its economy, and maybe most importantly, it could give us a much better idea of the economic well-being of a huge chunk of the population.
Okay, so we've diagnosed the problems. Now let's shift gears and talk about the solution. This brings us to the road ahead. The plan to give India's statistical backbone a much-needed upgrade, with a target date of 2026.
The good news is there's a comprehensive overhaul in the works. The plan is to update those outdated base years for all the major indices, revise the methods used to collect data in the first place, and then launch a whole new data series. The ambitious goal for all of this is early 2026.
And this isn't starting from zero. India's data estimation has improved over time. For instance, the last update in 2011-12 brought in detailed corporate data, which was a big step. The next big leap forward will be integrating data from the Goods and Services Tax, or GST network. That should provide a much clearer, almost real-time view of what's happening in the economy.
Which leaves us with one final powerful question. The IMF C grade was a real wake-up call about the risks of delaying these data upgrades. So, with a modern statistical backbone finally on the horizon for 2026, you just have to wonder, what new, more accurate picture of India's economy is finally going to emerge?